A home ownership, a significant milestone in life, is often made possible through home loans. These financial tools, provided by banks and other lending institutions, enable individuals to purchase homes by spreading the cost over an extended period, typically 20 to 30 years. Home loans, also known as mortgages, are pivotal in making the dream of owning a home a reality for millions of people. In our journey today, we'll demystify the world of home loans, guiding you through the different types, preparing for a home loan, the importance of credit scores, the application process, and finally, managing your home loan. We'll also shed light on the key role of mortgage brokers and the potential benefits of refinancing your home loan. So, whether you're a first-time buyer or considering a new home, this guide will serve as a roadmap to navigate the home loan landscape. Embarking on the journey to home ownership can be exciting and, with the right guidance, less daunting. Yes. Home loans, or mortgages, are a tool for purchasing a home without paying the full price up front. Essentially, a financial institution lends you the money to buy a house and you agree to repay that loan over a set period with interest. It's a key stepping stone on the path to home ownership, enabling you to convert your monthly rental payments into an investment in a property of your own. Now, let's delve into the various types of home loans. First, we have fixed-rate home loans. These come with an interest rate that remains constant for the life of the loan. You'll have predictable monthly payments, but if interest rates fall, you won't benefit unless you refinance. Adjustable-rate mortgages, or ARMs, have interest rates that adjust over time. Initially, the rate is typically lower than that of fixed-rate loans, but can increase or decrease thereafter based on market conditions. Next, there are Federal Housing Administration, or FHA loans, designed to assist low to moderate income borrowers. They require a lower minimum down payment and credit score than many conventional loans. Veterans Affairs, or VA loans, are accessible to service members, veterans, and eligible surviving spouses. They offer competitive interest rates, often without requiring a down payment or private mortgage insurance. Lastly, the United States Department of Agriculture, or USDA loans, are aimed at rural and suburban homebuyers who meet certain income limitations. They also offer the possibility of zero down payment. Each type of home loan has its unique features and eligibility criteria, tailored to suit different financial situations and home buying needs. By understanding these options, you can identify which type of home loan aligns best with your circumstances. Understanding the types of home loans available is the first step in making an informed decision. In the next scene, we'll explore how to prepare for a home loan, so stick around. Before diving into the home loan process, it's crucial to evaluate your financial readiness. Your financial health will largely determine the kind of home loan you can secure and the terms that come with it. So, where do you start? First, consider your credit score. This 3-digit number is a snapshot of your credit health and is often the first thing lenders look at. A high credit score can open doors to favorable interest rates, while a lower score might make lenders hesitant. Next, take a look at your income. Lenders want to see stable and sufficient income that can comfortably cover your anticipated mortgage payments. They'll also evaluate your employment history, so a steady job can be a big plus. Then there's your debt-to-income ratio, or DTI. This is a comparison of your monthly debt payments to your gross monthly income. A lower DTI shows lenders that you have a good balance between debt and income. Typically, lenders prefer a DTI of 43% or less. Once you've assessed these factors, it's time to set a realistic home buying budget. This budget should not only include the cost of the house, but also additional expenses like property taxes, homeowners insurance, and maintenance costs. A popular rule of thumb is the 28-36 rule, which suggests that no more than 28% of your gross monthly income should go towards housing expenses and no more than 36% towards total debt payments, including your mortgage. Remember, the amount you can borrow is not always the amount you should borrow. Be mindful of your comfort level with a potential mortgage payment. Lastly, consider your down payment. A larger down payment can reduce your loan amount and potentially your interest rate. However, don't deplete your savings entirely for a down payment. It's important to have an emergency fund for unexpected expenses. By understanding your financial health and setting a realistic budget, you're laying a solid foundation for the home loan process. Remember, a home is a long-term investment. Making sure you're financially prepared can help ensure that it's a rewarding one. A solid financial plan is the foundation of a smooth home loan process. Choosing a mortgage lender and getting pre-qualified are key steps in the home loan journey. When it comes to selecting a mortgage lender, it's all about doing your homework. Look for reputable lenders who offer competitive interest rates, favorable terms, and low fees. Don't be afraid to ask questions or seek professional advice if you're feeling overwhelmed. Once you've narrowed down your choices, it's time to get pre-qualified. This process involves a lender evaluating your financial situation to determine how much you might be able to borrow. You'll need to provide information about your income, assets, and debts. Remember, pre-qualification is not a guarantee of a loan, but it does give you an idea of what you might qualify for. It's a valuable tool in your home buying arsenal, helping you to focus your house hunt and make realistic decisions. Pre-qualification can give you a clearer picture of what you can afford, bringing you one step closer to your dream home. Your credit score plays a vital role in securing a home loan. You might ask, what is a credit score? Well, it's a 3-digit number that lenders use to evaluate your credit worthiness. It's like your financial report card, and it's based on your history of borrowing and repaying loans. So why does it matter? Because it directly impacts the interest rate you'll get on your home loan. A high credit score can save you thousands of dollars over the life of your loan. Conversely, a low score might make lenders hesitant to offer you a loan at all. Now let's talk about improving your credit score. It starts with paying your bills on time, reducing your debt, and avoiding new debt. Regularly checking your credit report for errors and correcting them can also help. Remember, improving your credit score is a marathon, not a sprint. It takes time, but the payoff is worth it. A healthy credit score can open doors to favorable loan terms. Applying for a mortgage is a comprehensive process that requires careful preparation. This journey begins with the submission of a mortgage application. The application form is where you lay out your financial story. It includes details about your income, assets, debts, and a host of other personal information. It's crucial to be honest and accurate, as this information will be verified during the underwriting process. Next, it's time to gather your supporting documentation. This typically includes recent pay stubs, tax returns for the past 2 years, and bank statements. You might also need to provide documentation for any large deposits or withdrawals in your bank account. The aim is to give the lender a clear picture of your financial health. Now let's talk about mortgage brokers. These professionals act as intermediaries between you and potential lenders. They can help you find the best loan options based on your financial situation and guide you through the application process. They have a deep understanding of the market and can help you navigate the complexities of the mortgage landscape. However, keep in mind that while they can be incredibly helpful, they do charge a fee for their services. It's up to you to decide if their expertise is worth the cost. After you've submitted your application and all necessary documentation, your application goes to a loan processor. They will organize your documentation and may request additional information. Once everything is in order, your application heads to the underwriting department. Here, an underwriter will verify all your information, check your credit, and assess your ability to repay the loan. The underwriting process can take some time, so patience is key. Don't be alarmed if the underwriter asks for more documentation or clarification on certain points. This is all part of ensuring that you're a good fit for the loan. Remember, the mortgage application process is a meticulous one, and it's important to be thorough and organized. A well-prepared mortgage application can expedite the approval process. Once your mortgage application is approved, you're on the final stretch towards home ownership. The underwriting process is where your lender verifies your information and ensures the property meets their requirements. It's essential to respond promptly to any requests for additional documentation to avoid delays. Now comes the closing process. This is when you'll sign the final paperwork, pay your down payment and closing costs, and officially become the homeowner. Make sure to review all documents thoroughly. Don't be afraid to ask questions. After all, this is likely one of the biggest financial decisions you'll ever make. Managing your home loan effectively is crucial. Make your payments on time and consider setting up automatic payments to avoid any late fees. Keep an eye on interest rates too. If they drop significantly, you might want to consider refinancing your loan. Successfully closing on a home loan is a momentous achievement, but the journey doesn't end there. Securing a home loan can be a complex process, but with proper planning and understanding, it becomes manageable. We've journeyed together through the intricacies of home loans, and it's now time to consolidate our knowledge and take away some final tips. We commenced our exploration by understanding what a home loan is and the different types that exist. We learned that home loans open the door to home ownership, and that there are a variety of loan types, each with their own features and eligibility criteria. From there, we moved on to preparing for a home loan. We highlighted the importance of assessing your financial readiness and creating a realistic budget. Remember, the key factors lenders consider include your credit score, income, and debt-to-income ratio. It's essential to ensure these are in good shape before applying. We then delved into the research and planning phase. We learned about choosing the right mortgage lender and the benefits of getting pre-qualified. Comparing interest rates, terms, and fees can make a significant difference in your home loan experience. Next, we focused on credit scores and their role in home loan acquisition. We discussed ways to improve your credit score and the importance of managing your debt responsibly. We also navigated through the mortgage application process, shedding light on the necessary documentation and the role of mortgage brokers. We further explored the underwriting process, potential issues that may arise, and the steps involved in closing a home loan. Finally, we discussed managing your home loan, the importance of timely mortgage payments, and the option of refinancing. As we round up, remember that the home loan journey is unique for everyone. It's okay to ask questions, seek professional advice, and take your time to make informed decisions. Be proactive in your approach, manage your finances well, and always keep your long-term goals in sight. Remember, the journey to homeownership is a marathon, not a sprint. Take your time, understand each step, and take proactive measures to ensure success.